So again, everyone, welcome. Today we have about a 45-minute to 1 hour presentation, 10 proven strategies to help secure your financial future. This will be presented by the team at Centinel Financial Group, Anthony DiChara, Mark Sullivan, and Christine Vito. And with that, I'm going to hand it over to Anthony. The ball's in your court.
Great, thanks, Kevin. Good afternoon, everybody. This is the second session for today, and thank you all for attending. We certainly appreciate that. Special thanks to Kevin and Melinda for putting today's meeting on. So our goal today is basically to do a presentation. This is our most popular presentation here that we've been doing over the years. We've taken a little bit of a break during COVID, but here we are. We have a revamped program, so excited to bring that to you. For those of you that I haven't had a chance to meet with or speak to, my name is Anthony DiChara. And myself, along with Mark Sullivan, our managing partner, are the two advisors on the ATG 401k plan. And we also have Christine Vito here with us, who heads up our operation team. We have a number of these presentations. This is actually one of our most popular ones. So looking forward to bringing that to you today, and hopefully adding some value to the overall employee benefit package with ATG and McDevitt. This will be a pretty general presentation. It's not specific to any of the benefits with ATG or McDevitt. So we're going to be speaking more in general terms, but there will be time for Q&A at the end. So we'll run through some slides. We'll take a quick pause in the middle, and then we'll finalize and answer any questions that you'll have towards the end. So we can get this kicked off here with the 10 proven strategies to help secure your financial future. So strategy number one is really understanding where you stand today. So before you start to plan out your retirement or plan out some of the goals that you have, we need to know where you're at today and how to, kind of analyze that. So a couple of the variables that go into that. First is your current income and your current expenses. So when we sit down with the client for the first time, one of the strategies that we talk about is putting together a very quick budget, just getting an understanding about where you are, where your money is going to, how much money you either have left over in a surplus or maybe a shortage at the end of every month. And I think this is really telling because it opens a lot of eyes to, I guess, how much we're all spending and in what areas we're spending. And before you can kind of, analyze that, you have to know where your money is going. So budgeting is obviously a very important part of that. After you kind of go through a quick budget, obviously having your assets and liabilities lined up. So whether those are, a 401k balance that you have, maybe an old retirement account, your home equity, things like that, that make up your overall assets. And then any sort of liabilities you have. So, if there's a mortgage balance or if you have credit card debt, student loans, things like that, that's also very important to consider. So still here on strategy one is taking a look at, are you happy with this picture? So we spoke about it in the previous slide, but assets minus liabilities equals your total net worth. Again, this is another topic that we will go over with clients every time that we sit down, just so that you have a good idea about, where your progress is and how to track that. The overall goal, obviously, is to have your total net worth increase year over year. So whether that's regarding growth in the market, growth in your 401k, maybe the value of your home increasing, this is something that we'll always take a look at with our clients as well. Strategy number two is to be prepared for any emergencies. Don't wait until there's a crisis. We have three different types of emergencies that we'll talk about briefly. One is financial emergencies. So if for some reason, you need some work done on your home, let's say, a boiler goes or you need a new roof. The question is where do we get that money from? So what we recommend is we always recommend our clients have a 3 to 6 month reserve in cash or in a bank account, something that's liquid and readily accessible, so that you can have access to that if you need it. We don't want to have clients pulling out of, let's say, pulling out of their 401ks and potentially having penalties or taxes, or even taking money out of any sort of other savings vehicles that they've had designated more for long term. So again, 3 to 6 months of expenses is kind of a good ballpark amount to have saved on the sideline. This is also, something for medical emergencies. If you need a last minute surgery and, maybe you haven't hit your deductible yet, where are you going to be getting the funds for those types of emergencies? We also have written down personal emergencies. So these are things like, if you're, working longer than expected and need someone to pick up your child or something like that, making sure that you have a plan that's written out so that if you need something immediate, that this is something that you have kind of, worked out, and that way you don't have to struggle for kind of last minute plans there. Third strategy that we speak to our clients about is insuring for the unexpected. And this really deals with life insurance in particular. So most people that we meet with need life insurance, but we also feel that a lot of people are either underinsured or maybe they haven't really taken a look at their current life insurance and see if it's still appropriate based on their goals. So just from a very general standpoint, we always mention maybe you consider 5 to 7 times your annual income in terms of total life insurance. So it doesn't necessarily matter what type of insurance you have, if it's a term policy or maybe a permanent policy, but the most important thing to consider is the amount of death benefit or face value of that insurance. So again, just a general standpoint, 5 to 7 times your annual income should at least be a good starting point. We always share with clients that you don't climb the mountain all in one day. If you can only afford, maybe 3 to 4 times your salary, that's okay. You can start there and work your way up. We'd always, rather our clients have some form of insurance than not have any at all. Don't forget that you're also looking to get insurance for a stay-at-home spouse, if that's the case, because if something were to happen and you need somebody else to take care of your children if your spouse passes, it's always important to, kind of replace that time, replace that income, so to speak, that you normally would be, getting from work. So making sure that both spouses are insured is really important there. We spoke about it briefly, but there's obviously different types of life insurance. And that's where we can sit down with clients on an individual basis and make sure that they're educated on the different types of insurance and what might fit their needs the best. Outside of life insurance, we also talk to clients about disability protection. So whether it's short-term disability, long-term disability, or getting a supplemental policy, having the appropriate amount of disability coverage, if you were to, get sick and not be able to work, how do we replace that income? And disability insurance is definitely one of those areas. Long-term care insurance is more of insurance for individuals as they get a bit older, and maybe they need excessive care. So maybe that's in-home care, maybe it's assisted living facilities, maybe it's adult daycare centers down the road, or eventually nursing homes as well. Long-term care does protect against that type of care where you might need help with activities of daily living. Strategy number 4 is really focused on estate planning and making sure that you have the appropriate will set up. So again, most people need a will, but as you can see by the chart, it's about 54% of people do not have a current will. So the most important thing here to consider is that it doesn't have to be overly complicated. You don't have to sit down with a fancy, expensive attorney to draft all of these different documents. I think the most important part is that you put your wishes down in writing and that you have that in a safe and secure place so that if something were to happen to you unexpectedly, maybe your beneficiaries, your spouse, your children know where to go to access that. So having your wishes written down is probably one of the most important parts of estate planning. And it can be very simple, maybe a little scary to write that out, but definitely a step in the right direction when it comes to estate planning. Obviously determining who will inherit what. So whether it's an asset like a 401k or savings plan, or just maybe your home, your car, things like that, really important to have that written down. Obviously, if you have children, making sure that you name an appropriate guardian for them, and also an executor for your estate. So, somebody that you trust, whether it's a family member, a child, a spouse, maybe even a non-biased party, somebody that's a third party, can also be an executor of your estate. Estate planning is more than just taxes. We speak to our clients about this, but essentially what it does is it protects your assets not only during your lifetime, but also helps to distribute them properly to the correct heirs when you're no longer here. And again, it's not just for the wealthy. Every person that has final wishes should have something written down. Make sure you consider things like family members with special needs, if you're divorced or maybe remarried, if there's stepchildren in the picture, an ex-spouse. These are important things to consider as part of your estate planning plan as well. As a whole, estate planning will help to minimize death expenses, avoid death taxes, obviously dependent on the state that you live in and the state's rules. It helps deliver the assets to the appropriate people that you wish that they go to. Also, from a business standpoint, let's say you have a business and you want that business to survive, making sure that that goes on to the appropriate person from a business continuity standpoint. That's also part of a proper estate plan. Can also help to ease the burdens on your heirs and your loved ones. Think about it, they're probably going through, one of the most, if not the most difficult times in their lives dealing with the loss. But, to have to deal with, calling all of these different companies and trying to figure out where your assets are, it's really important to kind of ease that burden on your family as well. We spoke about this earlier, but also, naming a guardian for yourself should you become incapacitated. And I think that this really lends itself to healthcare proxies, which are really important and a really solid foundation of any proper estate plan, so that if something happens to you and you're incapacitated and can't speak for yourself and your own wishes, making sure that you have a healthcare proxy, somebody that can carry out your wishes, is really important. Fifth strategy here is to reduce debt. So I'm sure we all have a certain level of debts on the books. So here are a couple of just interesting credit card facts. So Americans currently have over $787 billion in outstanding credit card debt, with an average interest rate of over 15%, close to 16%. I think we've all probably had some credit cards that are 20+%. And we spoke about this earlier, but if we're in very low interest rate environment and you're getting maybe a 0.25%, at the bank, and you're paying close to 20% on debt, it can be really difficult to get out of debt if you go down that road. So making sure that you're paying off as much as you can and you're not paying high interest. Almost 3/4 of Americans have at least one credit card, and the median credit card balance is over $5,500. So just making sure that you control your debt will go a long way over the long term here. Obviously, not all debt is created equal. So some debt, like your mortgage, might be considered, good debt. Obviously, low interest rates can help you, pay even less for your monthly mortgage payment. So while we're still in the, historically low interest rates, we basically hit all-time lows about a year ago, and we're still relatively low. I think the general consensus is that we will see rising interest rates start to tick up here over the next few years. So whatever you can do to lock in low interest rates today, whether that be on your mortgage, maybe you're consolidating, student debt, or maybe you're just trying to move some of your credit card debt to maybe a 1 year, no interest credit card. Those are ways that you can help reduce your overall interest rate that you're paying, and maybe get that debt paid down a lot quicker while we're still in, historically low interest rates. As you can see with the chart going all the way back to 1975, if you look at the home mortgage rates, those have come down quite significantly from the 80s, but I think we might start to see that tick up here over the next few years.
So before we get to the next 5 tips, a reminder, if you have any questions, please use the chat function to submit any questions. The first 5 topics were knowing where you stand today, being prepared for emergencies, ensuring for the unexpected, create a will and estate plan, and reduce debt. So Anthony, I'm going to reframe a question from the first call around your thoughts around debt consolidation services and what role, if any, CFG can play in that.
Great question, Kevin. Yes, we spoke about this earlier. So we are a full financial planning firm, and that takes into account all sorts of different types of planning. We do not specifically deal with debt consolidation, maybe like some of those radio ads or television ads that you've seen. But what we found useful and what our clients have found very useful is that when we sit down or we have a virtual conversation surrounding your specific goals, we can absolutely address your questions on debt. Every individual is going to be different. Your debt amount, your interest rates, your goals are all going to be individualized. So at the end of the day, we are more than happy to discuss your specific debt plan, so to speak, but we do not offer those types of debt services that you might see advertised on the radio.
Thank you. And with that, we'll move on to strategy number 6.
Great. So strategy number 6 is several slides here. So I'll take my time to go through this, but this is one of the most important strategies, is investing for the long term. So this is a chart that shows the growth of $1 over time, going all the way back about 30 years here to 1991. And all of these, titles here along the graph are, events that have happened that, while we were going through them, maybe it seems like the end of the world, and the stock market's, going to be down here for the foreseeable future. And if you kind of go back, some of these things, that Y2K concerns around the millennium, the 9/11 attacks, obviously, the Iraq War, and then more recently, the COVID pandemic, which happened over the last 2 years. At all of these times, the market took a bit of a pullback. But if you look at the stock, right, the top line there, it shows that a $1 invested in a stock in 1991 would be about $21 today. And if you compare that to a US bond, your $1 might be worth about $5.50, and there's a lot less, volatility on that line, and even less is with your cash. So if you had money in the bank or in a checking account, $1 in 1991 might be closer to a little over $2 today. And you can also see the inflation line there at the bottom. So just an idea to kind of keep you on target when you're invested over the long term, because the market's going to go through its cycles. It's going to have good years and bad years. But if you focus on long-term growth and you stay disciplined, that's what's going to carry you through the good and the bad times. I will make just a quick note about inflation. Over the last 30 years, it really, wasn't that high in terms of inflation, but most analysts and most economists feel that inflation is definitely back, and we've obviously seen it, with the highest inflation we've had since the early 1980s. So expect that trend to continue here. Hopefully not too long, but inflation is definitely back. And one way that you can combat inflation is by investing in equities or stocks or those longer-term investment options. Little quote here from Warren Buffett, maybe a little bit sarcastic, but the best time to invest is when the market is open. And I think that lends itself to the previous slide, where you don't want to look to time the market. At the end of the day, the market's going to have its good and bad days. So any time is really a good time to be invested, as long as you're focused on the long term. Continuing with strategy 6 here. Whenever we sit down with the client, one of the most important things is to consider your goals and your investment considerations. So what are your objectives? What are you looking to accomplish? What's your time frame? Are you looking to invest this money, for 1 or 2 years, or are you looking at a 20, 30-year track record? That's very important when it comes time to choosing the investments. Obviously, the risk and reward profile, if you are a more aggressive investor versus a more conservative investor, and anywhere in between. Obviously, any tax implications that affect your life, we can discuss that as well one-on-one. And maybe whether or not you should be invested in a variety of stocks, bonds, mutual funds, or maybe a combination of all of those instruments. Just some general information here. What is a stock? Very simply, a stock represents a share of ownership in a publicly traded corporation, and it's also referred to as equity. You may see that that term if you see we're investing in equities. That means you're investing in a variety of different stocks. Why invest in stocks? Obviously, it's part of balancing your portfolio, and you have exposure to different types of stocks and maybe different types of sectors that those stocks are invested in. But the most important opportunity for stocks is that long-term growth potential. And if you look back to the chart that we spoke about earlier, you know, these stocks had maybe it had the highest volatility, but it also had the highest growth potential over the long term. What is a bond? So rather than ownership in a company or a corporation like a stock, a bond is where an investor will lend money. You become the lender to the corporation. So essentially, you give X dollars to a company, you buy their bond, and they promise you payments with interest over 30 years, and you know maybe they'll give you your principal back upon the maturity date. So obviously, stocks are traditionally more volatile than bonds, but it doesn't mean that bonds do not carry any risk. There are certain risks that are associated with bonds, and those should be considered carefully as well. Why do we invest in bonds? So rather than the outstanding growth potential, there is still growth potential there, but the goal is mostly focused on income. Another way to balance your portfolio, obviously, and this is for more moderate growth potential. I will add that it's important to remember that interest rates and bonds traditionally have an inverse relationship. So what I mean by that is as interest rates go up, which we are kind of projecting interest rates to increase over the next few years, bond prices tend to fall. So we might be used to bond prices being on the up and up over the last 30 years because interest rates have basically come down for the last 30 years. But what happens is when interest rates start to tick up, your bond allocation may not grow at the same rate that you are used to for the past 20 or 30 years. So just another something to consider, and that's something that we can sit down with clients and have a further discussion. So we spoke about bonds, spoke about stocks. Now, mutual funds, this is something that many of you might be familiar with because this is the underlying investment option of your 401ks. So a mutual fund is a collection of stocks, bonds, or money market securities. It is owned by many investors, pooled investors, who share a common financial goal, and it's managed by a professional investment management company. How a mutual fund works. An investor will, in a mutual fund, will buy shares of the fund, and as such, each share represents ownership in all of the fund's underlying securities. So I used this example earlier. Let's say you went out and bought Tesla stock. That stock can do really, really well, or it could also have some really bad days as well. But if all your money is in, all your eggs are in one basket, so to speak, you're really at the mercy of that one company. However, you could be invested in a mutual fund that also owns Tesla, but maybe their overall portfolio only owns 2 or 3% of Tesla stock. So when the money goes up, when Tesla, goes up in value, you're taking advantage and you're growing with it. But if we go, into a downturn with that, and Tesla loses 20% overnight, you're not hit as hard because your percentage of ownership in Tesla is much lower than if you just bought that Tesla stock on its own. Why do we invest in mutual funds? Well, it gives you a benefit of both stocks and bonds, plus professional money management, allows investors to pool their money, diversification, obviously, low minimum investment. So even if you're investing, $50 a week in your 401k plan, you have access to some really fantastic managers and some fantastic investment options, but at very, very low minimums, which traditionally speaking are not available. Also, you have instant access to your money. So even though 401ks, have age limitations, if you own a mutual fund today, you can go and sell it, tomorrow. It doesn't mean that you're locked in, and you can make changes with your own portfolio. So you have an ability to make adjustments there on the fly. Understanding risk, obviously, anytime you're investing in a stock, a bond, or a mutual fund, There are given levels of risk that should be considered carefully: financial or company risk, market risk, economic risk, inflation, which we're starting to see a bit more lately, interest rate risk, credit, currency risk, all sorts of different risks that we should be discussing with clients. Some strategies to reduce risk over time is diversifying your portfolio within a variety of different mutual funds. Dollar cost averaging, which I will go into in a separate slide here. Always important to remember, don't try to time the market. It doesn't always work out the way you think. And when you think the market's going to go up, sometimes it goes the opposite way. And when you think the market's going to have a pullback and it just keeps on roaring, it's important to not try to time the market, stay disciplined, look for the long-term results, and work with a financial professional. So before we get to the next strategy here, I just wanted to take a quick pause. Kevin, if there are any questions here, I'm happy to talk about that.
At this time, there are no additional questions. Please, as a reminder, use the chat function if you have any questions.
Great. So strategy number 7 deals with asset allocation, which is something, if you are invested in your company's 401k, you might be familiar with, because this is part of how 401k investments are looked at. So asset allocation is simply the process of dividing assets amongst different types of investments, such as stocks, bonds, mutual funds, and cash. Time horizon and risk tolerance are keys to asset allocation. This is a pretty cool chart here where it shows the potential growth and potential decline of the market. This is the S&P 500 over a 1-year period, 3, 5, 10, 15, and 20. And I think it's really important to focus on the long-term results. So the market can have a really good or a really bad year in any 1 year. But as you get closer and closer to looking at it long-term, once you get past the 5 or 10 years, you start to see a regression to the mean there, where your average return starts to come down a bit, where there's less volatility and a little bit more consistency with the long-term results. So again, this lends itself to staying patient, staying invested for the long term, and staying disciplined during the best of times and the worst of times. Importance of rebalancing. This is also something that happens in your 401k. Let's say that we meet with you, and based on your risk tolerance, we determine that a appropriate portfolio for you is 50% stocks, 25% bonds, and 25% cash. Now, naturally, because stocks are more volatile, but also have a higher growth rate, eventually what's going to happen is you're going to get portfolio drift over the long term. So without even doing anything, your stocks are going to increase faster than the bonds and cash. So all of a sudden, your portfolio allocation or value of the account might be out of sync with where your original goals are. So part of what we do as an advisor team is we get you back to that target allocation by rebalancing your portfolio, and this adds discipline to the overall investment process. Strategy 8 is something, again, that we are taking advantage within the 401k, dollar cost averaging. The way that this works is this is a strategy where you spread purchases over high and low price periods, and it helps you accumulate more shares at a lower cost. So I'll go to a really simple example here. Let's say you were investing $100 a month into a 401k plan or any type of other investment. Let's say that first month, that mutual fund that you're buying is $10 a share. You invest $100, you buy 10 shares. The next month, that mutual fund increases in cost to $20 a share. Well, now you're investing 100, still the same amount, but you're only buying 5 shares. And let's say the next 2 months, it's $25 a share, so you're only buying 4 shares. What you're essentially doing here is by investing a periodic amount that's the same every month, you are buying more shares of that mutual fund when the price is lower, and less shares when the price is higher. So automatically over the long run, you are bringing down the average share cost over time. This does happen automatically in your 401k plan, and any sort of mutual fund investment we discuss with our clients implementing a dollar cost averaging strategy. Strategy number 9 is making sure that you contribute as much as possible or contribute the maximum to your retirement plans. Most important to pay yourself first before you start to spend money or pay some of those additional costs. Pay yourself first. You can do this in a variety of ways, whether it's pre-tax contributions or Roth contributions. Also, you're taking advantage of a free match, and I will add that both the ATG and McDevitt plans do have a very generous match. So make sure that you take advantage of that. It's a painless savings plan. So think about it. You get your check every week, but before you get your after-tax amount direct deposited, you saved a little bit into your 401k. So even if you're running into a tough month and you spend through all of your earnings, at least you know that you saved first before you spent anything, and you can feel better from that standpoint. Also, from a tax standpoint, you're going to get overall tax deferral on your retirement contributions and all of the growth, which will help you over the long term. Continuing there with strategy number 9, this is a really good chart to show you the difference between a tax deferred asset like a 401k or a traditional IRA versus a taxable investment. So sometimes you might hear people say, oh yeah, I decided against my 401k, but I just decided to invest on my own outside. Well, one thing I will caution you is forget about missing out on the match, but one of the other benefits of the 401k is the tax deferral. So if you look at a 30-year time frame, investing $500 a month at 8% for 30 years, if you had all tax deferred growth, you'd have close to 750,000, and you might have half of that, close to half of that, if you're at a 40% tax bracket. Same thing with 20% tax bracket, still significantly lower. So take advantage of those tax deferred assets and make sure that you're taking advantage of your retirement plans by contributing the maximum if possible. Just a general contribution limits for this year. So IRAs, which are outside of 401k plans, you can contribute $6,000 a year with an additional $1,000 catch-up if you're over the age of 50. Simple IRAs have a $14,000 contribution limit, $3,000 catch-up. 401ks, which you might be the most familiar with, have the highest there, which is the $20,500 compared to IRAs or simple plans, and an additional $6,500 if you're over 50. So we have a lot of clients that are, in those twilight years where they're approaching retirement and they want to save as much as possible. They're able to contribute quite a large sum of money every year into their 401k and get that tax break right up front. Defined contribution plans obviously have a slightly higher contribution limit there as listed by the IRS. And then the last strategy here is seeking expert advice. So here we are, we're a team of financial advisors here at Centinel Financial Group, and we're able to do financial plans, look at your existing retirement accounts, look at any investments you have, and give you, our discussion or our recommendation based on your goals. But also you want to look at not just financial consultants and planners, but accountants and CPAs for proper tax advice, insurance planners, attorneys for legal advice. We always say to our clients that we're not CPAs and we're not attorneys. We can maybe give you some very general tax advice or general estate planning advice, but any sort of detailed discussion should be discussed with a CPA or an attorney to discuss your goals with them more in depth. Part of what financial professionals can help you out with is helping to clarify your investment goals, establish a financial plan for yourself. And I think most importantly, it's to reevaluate your goals, your progress, and your overall plan. Things change all the time. Life events happen. Maybe your goals have changed. Maybe your risk tolerance has changed. Maybe the economy has changed. At the end of the day, we need to be in front of our clients and making sure that we're updating them on those changes, but also if there are any changes in your world, that we're making the appropriate adjustments to your tailored financial plan. And lastly, there, just to remain disciplined, there will be good times and bad times investing in the market. You're going to have those really great years that get you excited, and you take a look at your statements and you're all happy, and maybe you file that away for next year. And then maybe the following year is a tough start to the year, but just maintaining that long-term disciplined approach, that's something that financial professionals can help you out with over the long term. Just a general word about risk. We spoke about stocks, bonds, mutual funds. There are all different sorts of risks associated with these financial instruments, and it's something that we can have a more detailed discussion about with you in person. So with that being said, that concludes our presentation. We really appreciate your time and attention today. We did leave our contact information for our team here. Feel free to reach out if you have any follow-up questions here after the seminar. But I will, hand it over to Kevin. And if there are any questions, we're happy to answer those as well.
Anthony, we have two additional questions. The first is, you often hear the term fiduciary as it relates to advisors. Can you explain what that means and why that may be important?
Yeah, I think most importantly, fiduciary means that you're putting your client's best interests before yours. Now, that may sound something that is, second to none. That's something that you should be doing anyway. But this was more just a legal precedent over our industry, and we are fiduciaries. So, when we sit down with clients, we need to have a detailed discussion with them that are based on their specific goals and making sure that we're putting your needs before the needs of anyone else.
Thank you. And a reminder, if you have any additional questions, please use the chat. Question from earlier, as we were talking about the 401k and IRA, is it possible for someone to contribute to both and in a Roth situation? Can you help us understand that ability to mix and match?
Sure. That's a great question that we get very often. And I will say that when it comes time to getting tax advice on investing in a traditional versus a Roth, again, always reach out to your CPA or tax advisor. However, to answer the question, you can contribute both pre-tax or traditional contributions and Roth contributions. Sometimes there are income limitations on a Roth IRA. So the IRS may cap you out or phase you out of any potential Roth contributions. But we do have clients that do both traditional 401k contributions, and they also do Roth IRA or Roth 401k contributions on the side. As long as you're not contributing more than the overall maximum contribution limit for that tax year, then you're in good shape. But again, I will remind you that there are income limitations and phase outs. So definitely speak with your accountant, because they're going to know what your adjusted gross income is. And that's what determines what you can and cannot do for contributions.
Thank you. There are no more further questions. Again, thank you for helping us understand some of these strategy, Anthony and the team there at CFG. If anyone would like their contact information, feel free to reach out to Relinda or myself, and we'll get that to you. As a reminder, this session has been recorded, and we'll be posting either this session or the morning session later today. And you should be receiving a survey as well, just to get your feedback on the session and some ideas for the next session in the future. So again, thank you, Anthony and team.
Thank you. Have a great day.
Have a great day.